Hello friends, in this session we will learn about the hybrid finance. So word hybrid means what? Simply hybrid means what? It is mixture of two, right? Hybrid means simply the mixture of a two. Now we can see here hybrid securities combine the characteristics of the both debt and the equity. So what do you mean by hybrid? If we talk about the security, right? We are having the two type of mainly security, the debt security and the equity. Equity means like a shares and debt means the loan, right? So if we combine both, we will get the new, right? And that is called as the hybrid. So the securities, the derivatives which shows the characteristics of both, for example derivative and the equity, that is called as the hybrid security. Okay, now see, the Indian companies utilizes the hybrid security such as the preference shares and the convertible securities, then the foreign currency convertible bond to optimize their capital structure. So if there is shortage of capital, right? So to raise the capital, the company can issue the hybrid securities. Equity represents the investment by promoters and the investor with a residual claim on the company's asset and managerial control. What do you mean by it? See, if you have the equity shares, right, that means generally the equity shareholders are the promoter or the owner of the company, right, and they will get a claim only residual. Means what? If company goes into bankruptcy, into liquidation, if anything remains after paying all the debt, then only the promoter or the equity holder will get money, right? And also they are having the managerial control because they are the promoters. Now see, the debt provide fixed claim on cash flow and asset but lacks the managerial control. Whereas in case of debt security, it is very different. If you are holding the debt security of a company, you do not have the control on the company. You cannot have the voting rights into their meetings, right? That means what? You will not have the managerial control if you have the debt security. However, in case of debt security, the return are well much fixed. The key form of a hybrid financing. So what are the type of hybrid financing? Mainly the preferential capital, the warrants, then the convertible debenture, and the different innovative hybrid that we have to discuss in this session. So see, the use of FCCB means the foreign currency convertible bond has declined recently as compared to the external commercial borrowing and the rupee denominated bond. See, recently FCCB have decreased with respect to the external commercial borrowing and rupee denominated bonds. Okay, now let's start with the syllabus. See, equity versus debt. What do you mean by the equity and the debt? See, equity share capital of a company is that type of capital which represents the investment by the promoter and the investor, who will always have the residual claim for the cash flow or asset of the company, which I have already told you, right? That means they will not get a preference in case of liquidation of the company. After, if company goes into bankruptcy, then first the money came from the by selling the asset of a company will be given to the preferential shareholders, then will be given to pay the debt. If anything remains after that, that will go to the equity shareholders. They also have the managerial control and the authority over the company because they are the promoters. On the other hand, the debt is often not related to with the managerial control but does not reflect the fixed claim on the cash flow and asset of the company. Okay, so but does reflect. That means if you are the debt security holder, that means you are not the part of management. You will not have the voting rights in meetings also. However, if you are the debt security holder, you will get some fixed amount in case of liquidation of company or in case of profit to the company. However, the asset and the cash flow asset, or in case of liquidation, whatever the remaining residual claim, you will get the priority. Okay, so this is very simple difference between the debt and the equity. So one simple thing you only remember, debt will have the good and the fixed return, whereas the equity holders are not always have the fixed return. It is based on the dividend. Apart from that, the equity holder will get a residual claim, means if anything remain, then only, whereas debt security holder will get a preference in case of the payment. It may be the dividend, it may be fixed return, etc. Okay, now see, what are the advantages and the disadvantages of the hybrid security? So what is hybrid security? First, see, it have the both the combination like a debt also and the equity also. So the characteristics shown by the hybrid security are of both debt and the equity. Now what are the advantages? See, higher yield means what? See, Hybrid securities generally offer the higher rate of return than the debt. Why? See, debt security and the equity. So, see, one simple thing. These are having low return but a fixed return. These are having high return but variable return. Because it is market linked and it is having more assured. Okay. So, what I can say, if you combine both, what is the good thing you will get? You will get the good return. So, the higher yield. So, the hybrid security will have a higher rate of return than the debt. Less volatile market price means what? See, in equity, market price changes very frequently, right? So, hybrid security shows a less volatility in the market price as there is a regular and a predetermined return. That means fixed return. Risk diversification. So, hybrid securities also diversify the overall risk because it combines both the debt and equity. So, these are the advantages. Now, what are the disadvantages of using the hybrid security? See, assessment is very difficult. Calculation of return is not simple, therefore the investing is more complicated. Okay, so assessment is very much difficult. Calculating the return is difficult, that we will learn, right? And the investment, that's why investing becomes complicated. So this is advantage and simple disadvantage of the hybrid security. Now see, what are the type of hybrid security which we have to learn? Simply, in most of the common types, the preference shares, the warrants, then the convertible debenture or the bonds, then the foreign currency convertible bond, and the mezzanine financing. So these are the type of the hybrid security which we have to learn. Okay. Now see, first preference share. What do you mean by the preference share? Preference shareholder have a high priority claim on both a company's income as well as the asset than the equity shareholder. See, name itself indicating you are having preference share of the company means you will be getting the preference. Okay. A dividend is guaranteed to preference shareholder and must be paid out before the regular shareholder. Okay. So, see, preference means you will get preference in case of distribution of a dividends after the profit. First, for example, company has some amount as a profit and they have to distribute the dividend. So, first dividend will be given to the preference shareholder, and if anything remain, then only the remaining equity shareholder will get the dividend. Okay. The preference share can be either cumulative or non-cumulative. Cumulative means what? Where dividend can be accumulated, and non-cumulative means dividend cannot be accumulated. For example, cumulative means previous year company is not in good profit, so not declared the dividend but not able to pay. Next year also company in a profit but not given the dividend. On third year, company can give the previous 2 year plus current year. That means for 3 year at one time they will give in the form of arrear, like bipartite arrear we are getting, right? So this is called as the cumulative. In case of our bipartite settlement, what is happening? Our salary is revised. We are getting the difference as arrear of a previous year which we worked, right? In the same way, if that means it gets accumulated, it gets accumulated. That's why the arrear comes here. So in case of cumulative, you get the dividend for the previous year also, but in case of non-cumulative, you are only able to get only for present year only, not the previous year. Okay, not for the past year. That's why very simple difference. Cumulative means arrear or the dividend can be accumulated. In non-cumulative, it is not accumulated. If not paid, the preference shareholder are not able to push the company into bankruptcy. So see, it is very, very important. If preference shareholders, if they are not paid the dividend, they cannot sue the company into the court, or they cannot push the company to the NCLT. Okay, there is another provision is that if continuous is not paid for 20 years, then they can have the voting right. These are the different and the lengthy process. But for instance, you only remember, for the preference shareholder, they are not able to push the company into the bankruptcy, or they cannot go to the NCLT if dividend is not paid. In case of liquidation, also preference shareholder will receive the amount before the equity shareholder. Okay, so even in case of liquidation also, preference means they will get the preference. Maximum period for which preference share can be issued is in India is 20 year. Okay, so for a maximum period of 20 year, the preference share can be issued, and also important, they do not carry the voting rights, right? Preference share will not have the voting right. Okay, so this is all about the preference share. Now see, there are different types of the preference share. Okay, now just see the list of it. Cumulative preference share means the dividend can be accumulated. Then non-cumulative means no dividend can be accumulated. Then participating preference share means you can participate in the profit of a company. Non-participating preference, see all we have to see in detail, just here go through the list. Then redeemable preference share, non-redeemable preference share, convertible preference share, non-convertible, adjustable rate preference share, and the perpetual non-cumulative preference share. So these are the some types of the preference share which we have to see. Now one by one, see what is a cumulative preference share. So the dividend on these share will continue to accumulate unless they are completely paid, which we already done, right? That is means dividend can accumulate in the form of arrear company will give. So the payment is done to the unpaid dividend are recorded as the contingent liability. If a payment is not paid of the dividend, then company has to pay it and to be recorded in the form of a contingent liability. Okay, remember this. If unpaid dividend is recorded in which form in the company's balance sheet, remember it is in the form of a contingent liability. Now see, the non-cumulative preference share means what? Simply these shareholder receive the dividend payment that is predetermined in advance. For some reason dividend is not declared, the right to receive the dividend for that year will be forfeited. That means they will not get the arrear or the cumulative dividend like a cumulative preference share. They are only getting for the present year, that is predetermined in advance. Okay, and if company says that we are not able to pay, then the right to get the dividend will be forfeited, means they don't have any right to get the dividend. Next, participating preference share means simply in addition to the fixed dividend, these shareholder also gets the right to participate in any surplus profit that remain after equity shareholder. Okay, if company has given the dividend also, right? For example, company had the profit of say 100 lakh rupees, and company after all expenses and given dividend all still remain the 20 lakh as a capital, as a extra they will remain after settling everything. So the 20 lakh can be distributed among what? Participating preference shareholders. Why? Because the name itself is indicating participating, so they can participate in any surplus profit of the company. Okay, now see, non-participating means these shareholder only receive the dividend at a predetermined rate and does not get any additional right in a profit like a participating preference share. Okay, now you see the redeemable preference share means what? See, these shares are issued on the condition that the company will redeem them after the specific period. For example, say in India currently 20 years from the date of issue. In case of infrastructure company, it is 25 years from the issue, or even earlier at the company's option. Remember, means what? See, these are share issued at a condition when company can redeem it after some period. For example, say Tata will issue the share called as the redeemable preference share. So company will issue it. So you know after 20 year value of Tata share obviously will be high. Currently it is at a say 500. So after 20 year you are confirmed that it can reach up to say 10,000. So in that way what you do, you will purchase the redeemable preference share. So company after 20 year from they will call you back. That means they will buy back from you. That is called as the redeemable. Means company can redeem it, and it is the company's choice. It is the choice of company. So these share also called as the callable preference share. The company may redeem them at a specific time and the date. That means company can call it back. That is called as buyback, right? Non-redeemable preference share means these share do not come with the arrangement like a redemption. That is callback. So these are redeemed by the company only on liquidation or shutting down of the Indian company are not permitted to issue the non-redeemable preference share. Okay, so this Indian companies are not allowed to issue the non-redeemable preference share, and in foreign country it is allowed, and redemption is not allowed in case of non-redeemable. Very simple, but only it can be redeemed only in case of company shuts its operation. Okay, now see, convertible preference share means what? See, these share can be converted into the equity share. Name itself indicating convertible means share can be converted into the form of equity. Okay, and it is the choice of shareholder in accordance with the terms and condition at the issue of the shares. Now see, non-convertible means simply which cannot be converted, the share which cannot be converted into the equity called as the non-convertible preference share. Okay, adjustable rate preference share means what? Simply, see, these shares do not have the fixed dividend rate. However, that's why you can say it is adjustable. So the dividend payment depend on the interest rate into the market. That means that's what is called as the adjustable. What is the interest rate into the market? Based on that, the dividend rate is defined, right, decided, that is called as the adjustable preference share. Now see, the perpetual non-cumulative preference share, in this preference share is issued to by the Indian banks only. Indian means the banks in India, as a part of additional AT1 capital. So you know, in India, how much capital we have to maintain as a bank? 9% of the risk weighted asset we have to maintain, right? So out of that 9%, so there is different type, like a CET1, common equity, tier 1 capital, tier 2 capital, all. Okay, so these are the part of risk management in the bank financial management. Now see here, see, if the company want to raise the capital under the part of tier 1 called as the AT1, additional tier 1 capital, if company want to raise, the company means the bank, then bank can issue perpetual non-cumulative preference share. Okay, remember, perpetual non-cumulative preference share can be issued by the bank to raise the capital only under the category of AT1. Okay, and there is a limit. How much? AT1, for AT1 is 1.5% only can be 1.5% is only allowed for the AT1. Okay, now excess of 1.5 if a company issues, right, and less than 2% and more than 1.5% will be counted for the tier 2, will be accounted for tier 2. Okay, so only simply remember, for this chapter only, remember, perpetual non-cumulative preference share issued only by the banks in India as a part of a AT1, additional tier 1 capital. Okay, and the limit is 1.5%. Okay, and obviously Indian banks means it will be obviously in the form of Indian rupee only. Okay, now see, purpose for issuing the preference share, why we issue the share? See, always anything when the shares are issued, the must purpose is to raise the capital. So what are the purpose for issuing the preference share? It is improved method for raising the capital. See, only issuing the share is different, but preference share means what? People will get preference, so they will have attracted to invest in the company. So it is a, for raising the capital, it is improved method. Company's share cannot be bought or sold. In such cases, will create the trouble in obtaining the fund, but the possibility of getting money back in the future could attract the investment. So if there is company whose shares are not tradable, right, and if that company issues the preference share where the money in the future will get back as per the future attract. So see, if the company shares are not tradable, many companies are there in stock market whose share cannot be bought or sold because nobody want to sell. So then it is not available to buy also, right? So in such cases, there is a trouble to getting the fund for the company, but the possibility of getting money back in the future will attract the investors. How? See, issuing the preference share, it will guarantee the more return in the future, so the investment for the investor will get attracted. Preference share are typically redeemed when there is excess of cash and no viable investment opportunity are available. That means when these are generally redeemed, when the company is having more cash, they can redeem it. That means they can buy back it. And if the company have no other option good to invest further and they are having excess money, then and no opportunity to other investment, then the company can issue the preference share. The company can redeem the preference share. If there is a loss or the reduction in the profit, there will be no dividend paid out, which is not a case with respect to the debenture. So obviously, if there is loss or the redemption in case of profit, there is no dividend paid out, which is not a case with respect to the debenture. That's why the preference share are issued into the market. Now see, what do you mean by the warrant? See, warrant is like a security, okay, instrument. So the warrant, the holder of the warrant has a right but not the responsibility to purchase the predetermined number of equity share at a predetermined price during the predetermined period. What do you mean by it? See, if I purchased a warrant for 20 rupees, okay, that means my 20 rupees will be with a company, say Tata. I purchased the warrant from Tata. So warrant means it will give me the guarantee that after 5 years, I can purchase 100 shares of Tata at a price, say 150 rupees per share. This arrangement is given by purchasing the warrant. Okay, so it is like a discount coupon to purchase share in future. Okay, it is like a discount coupon or the coupon that allows you to buy the shares or stock at the fixed price into the future. Okay. Now see, in some cases, warrants are attached to the debt instruments in order to sweeten the, or sweeten means in order to attract the investor. Warrants are oftenly attached with the debt instrument, means using the warrant you can purchase the debt instrument, and debt instruments are having fixed returns and these are very much secure. That's why people will get attracted. In many cases, the warrants are issued to promoters on a preferential basis to increase the stake into the company with a specified future period. So, see, due to the warrant, you can purchase the stock in the future, right? So, increase the shareholding in the future by the promoter. If what they will do, they will buy the warrant, because warrant gives the guarantee to buy in the future. So, warrant do not carry any dividend for voting rights because it is like a coupon. So, after converting warrants into the equity share, the investor gets dividend or the voting right. So obviously, once your warrants are converted into the equity share, you will get the voting right, but warrant do not have the voting right. Buyer has to pay 25% of the price upfront, which will be adjusted if the warrants are exercised, and will not if not exercised, the price which you paid for the warrant will be forfeited. That means what? If the price is 100, that means at 100 rupees you will purchase the stock after say 5 years. Okay, so currently you need to pay 25 rupees to purchase the warrant. Okay, this is the criteria, that 1/4 you have to pay. And if 5 year you are not able to purchase the share, your 25 will be loosened. You will lose the 25 rupees. Okay, simply warrants are like a coupon that allows you to buy the stock at a fixed price in the future. So warrants are also issued to the institutional investor or the strategic investor by the way of a preferential allotment. They will get a preference. Now you can see in IPO also there is some quota for the institutional investor. Okay, so in that way warrant can be done with respect to the institutional investors. Now see the convertible debenture. So it is a hybrid debt instrument that strikes the balance between the debt and equity, called as the it is a hybrid instrument. So convertible debenture is also type of the hybrid instrument. The company can convert equity into equity share fully or partially. That is a fully convertible debenture or a partially convertible debenture. So convertible debentures means they can convert into the shares. Debenture can be converted into shares. It can be partially or it can be fully. Now see, there are some guidelines. You can say there are 3 forms of the convertible debenture. So debenture are automatically convertible and having conversion provision that takes effect from after 18 months. Okay, see. Second, debenture with optional conversion feature that allow conversion within 36 months, and debenture with a allow conversion after 36 months but with the call and put option. So there are 3 features. Debenture will automatically convert. That will automatically get converted after 18 months. It will be converted debenture into the shares into the debenture. Okay, debenture, these are automatically convertible. Okay, so first see, based on that SEBI has derived 3 forms which are converted after 18 months, right? And which are converted after 18 months but give you the time period up to 36 months. That means after 18 months. Second is after 18 months but before 36 months. And third is after 36 months but with a call and a put option available, right? What do you mean by call? Call means company has a right to buy your share, and put means you have a right to sell your shares. That is called as call and put feature. Okay, so simply after 18 months, right, within 36 months, and after 36 months with the call and put option. So these are the 3 forms for conversion. Okay, remember that 3 form after 18 months, within 36 months, and after 36 months with the call and put option. Okay, that's why I have highlighted. Okay, you only remember at least the highlighted words. Okay, so that can be important for exam point of view. In the form of MCQ they can ask you. Okay, that is called as the convertible debenture forms. Now see, what is the difference between the convertible debenture and the warrant? See, the debenture and the option into the convertible debenture cannot be separated from each other. So in case of convertible debenture, the debenture and option cannot be separated. However, a warrant is issued if issued as attachment to the debenture and can be removed at any time. So you know, warrant is like a coupon which can be removed anytime. Debenture cannot be attached. However, warrant can be issued on their own and need not to be attached with any other instrument. The same. Debenture have fixed term. Warrants normally be exercised for monetary compensation. Conversion for of a convertible debenture is only for accounting purpose only, but whereas the warrant is for injection of capital. That means for to raise the capital, company issue the warrants. Convertible debenture have a call option with option for refund and the conversion, but warrant cannot be cancelled. It will get automatically forfeited. Means you will lose the money. Convertible, you will lose the money if not redeemed. Convertible are long-term instruments. However, the warrants are used for short-term, generally 5 years. Okay. Now see the foreign currency convertible bond (FCCB). So the foreign currency convertible bond is issued in the foreign currency, and name itself is indicating, right? Hybrid bond, the convertible bond is a hybrid of a debt and equity. That's what it is called as the hybrid security. Now see what are the features of FCCB. See, the holder of the foreign currency convertible bond will get the regular coupon and the principal payment, but they also gets the option to convert bond into the equity share. The same way they are having bond, it is name is bond. That's why they will get the regular fixed return. Also, they will get some amount as a principal investment. Also, they are having chance to get converted into the equity. That is called as the convertible. Conversion rate is specified in terms of issue. When the bonds are issued, at that time only they will fix what is the rate to be used for the purpose of conversion. If the stock price is below the conversion price, then the relevant date the holder will not convert. So obviously, if you have invested 100 rupees and currently if you convert the bond into the share price is 50, whether you are able to convert, you will not convert because it is loss, right? So it is the choice of the holder. FCCB investor are usually hedge fund and foreign investors. So generally, obviously, see, these are foreign currency convertible. Who will invest? The foreign investor, right? These bond may also have the call option, whereby the right clearly redemption lies with the bond issuer. Put option, whereby the right for early redemption lies with the bondholder. That means the bond issuer means the company has a right to call. Bond issuer, who is issuing the bond? The company. Company has a right to call, means company has a right to get it back, means buyback. And put means the right, the redemption means what? Who will sell? Obviously, the bondholder has a right to sell. See, always remember one simple thing. Call means buy, and put means sell. So who can buy? The company. Put means sell. Who can sell? The bondholder. Okay. Now see, what are the features? Again, see remaining features. The foreign currency convertible bonds are generally issued by the corporates in the currency which are stable. Okay, obviously. And the FCCB carry the lower interest rate than the regular bond because inherent option available to convert into the equity. So see, this bond can be converted into the equity. That's why the interest rate is less as compared to other. If the bondholders do not convert their bond into equity, the issuer will have to make the principal repayment on a maturity. This is called as the bond. See, what is bond? Bond means you have invested 100 rupees. For a 5 year, you are getting 5% yearly. Also, at the end of 5 years, you will get 100 rupees your back. This is the bond, and if you are not converted that bond into the equity, you will get the same 100 rupees at the maturity back. See, the terms of FCCB generally around 5 years. So generally for 5 years, the foreign currency convertible bonds are issued. Holders of the FCCB are exposed to exchange rate risk and the credit risk, obviously. See, generally nowadays the foreign currency convertible bonds are very less used because the external commercial borrowing and the rupee denominated bonds are more used in India. So if the issue company goes bankrupt, the repayment of the principal at a maturity will not be there. See, if company loses, how you will get the money? In case of a bond also, that is what mainly the foreign currency convertible bond, you will lose your principal whatever you invested. Do not need not be backed by any collateral. So because there is no any security or no collateral against the foreign currency convertible bond, and they are listed and traded on the foreign exchanges like they are traded like debentures. Okay, so they are well listed and can be traded on the foreign stock exchanges like debenture. Now see, valuation of the warrants. So we learn about the warrants also. Now we have to see how we can do the valuation of the warrant. See, important thing for MCQ point of view, which of the following can be used as model for a valuation of a warrant? So remember, the Black-Scholes model is used for a valuation, which is also used for a valuation of options. Okay, so remember, the Black-Scholes model is used for a valuation of the warrants as well as option also. Okay, so which variables are used while valuation? See, the fluctuation in the price of the stock, remaining time before the expiry, that is time remaining before expiration, the risk-free interest rate, the value of the stock, and the exercise price. Okay, so that are variables which you have to remember, because in exam they will ask you which of the following variable is not used for the valuation of the warrant. Okay, so remember, fluctuation in the price, then the time remain before expiry, interest free, risk free rate, and the value of the stock, and the exercise price. So these are the 5 variable you need to remember. Okay, now see friends, there is one example which we have to see for the black shoe model. See, black schools model. So this is used for valuation of the warrant. So see, this is more complicated. This example is more complicated. I recommend, if you do not want to waste your time, because you can skip it, because see, this is lengthy, they will not ask you. Okay, what type of example they will ask, I will tell you. Okay, just to go through it. Okay, for sake of understanding, see what they have given. The stock price, current price is S0125. Okay, total number of warrant is 1.6 lakh issued by the company. Exercise price E is 100. Time before expiry, time to expiration is a 6 month remaining, that is half year. Annual standard deviation of a stock price sigma they have given 0.4. Risk free rate they have given 8%, that is 0.08 you will take. Log n is a mathematical operation, and n is the capital N is the cumulative distribution function. Now to find the actual price, we have to use the 4 steps. Okay, so remember, they can ask you in the form of MCQ, how many steps are there in the black shoe model for finding the price. Okay, for the valuation purpose. So it will be 4 steps. Remember, first step we have to find the D1 and D2. Okay, so formula for D1 is this. Okay, log n S0 by AE plus R plus sigma square upon 2 into D divided by sigma root D. Okay, so simply put the value. We have the value S0 125, E is 100. Okay, R is 8%, that is 0.08. Okay, in that way simply put the value, you will get the D1. Simply how to find D2? D2 you are having formula. D2 is nothing but D1 minus sigma root T. Okay, put the value, you will get D2. Okay, then you have to find ND1 and ND2. This is what the probability you have to use. You have to use the table, or they will provide you the value in the exam directly. Okay, simply find the values from the probability table for the D1, D2. Okay, these are the value of a normal distribution for D1, D2 which you have find. Okay, or otherwise they will provide you examination. Now in third step, you have to estimate the present value of exercising of the exercise power, exercise price. Okay, so formula for that is simply E by E raised to RT. Okay, and so these are lengthy calculation, that's why I am telling you they will not ask you this type of. Okay, but at least you should remember the formulas, etc. Now in step 4, you have to find the current price. Okay, so current price is nothing but what, S n D1 minus E upon E raised to RT n D2. Okay, put the value, you will get the current price. In that way you have to go through it. I recommend, if possible, you can skip it. Okay, now the important hybrid finance is the mezzanine finance. In case of mezzanine finance, this is the another type of the hybrid and the debt financing. It gives the lender the right to convert the debt into the equity of the company in case of default. If the company goes into the default, then the lender has a right to convert that into the equity. Okay, so it is very much good. If the as a owner of company, I can say, if I am bankrupt, I will convert whatever loan I am having, I will convert it into the equity. So the mezzanine financing is normally for, it is like happening with respect to the what, with respect to the idea in India. So shares of the idea has been purchased by the government, because lot of debt on there. So the government purchased the shares, and some company which are the more which are having more shareholding, their shares are converted into form of, their debt is converted into the form of shares. Okay, so as a company, as a owner of company, I will prefer this, because it gives right to the owner to convert my debt into the equity. So the mezzanine financing is normally for raising the fund for a specific project or financing, or even in case of acquisition. Okay, mainly in case of acquisition, that a mezzanine financing is used. It is very interesting. Mezzanine financing can provide higher return to the investor as compared to the normal debt instrument. For issuing company, the cost is lower than the cost of equity capital. That's why they are allowing conversion debt to equity. Therefore, it can be considered as a cheap equity, because cost is low. That's why it is a cheap equity. Cheap equity means, you can say in a controversy, expensive debt. Okay. Now see, the mezzanine debt is the unsecured debt, and the interest rate, it can be partially fixed or partially variable in case of a mezzanine finance. The typically maturity is for 5 years. Okay, so these are the bit for mezzanine finance. Remember, in case of mezzanine, there is one important bit. A right to convert debt into equity lies with not the holder, with the company. Okay, an important thing, the debt is unsecured, it is issued for the 5 year, rate is partially fixed, partially variable. Okay, now see some innovative hybrids. So there are different type of hybrids, and mainly for the innovative hybrids also. Okay, so in these innovative hybrids mean different instruments. See, if you combine two or more, it will get new generation instrument. Like, so in that case, the information of a hybrid security involve different combination. So how we can formation of a hybrid security involve different combination. For example, two different form, if you combine, you will get new, right? So such a conversion of a debt or the equity and the OTC derivative will give rise to new innovative hybrid instrument. For example, if you combine debt with the forward, if you combine equity with the swap, if you combine the debt with option, so everywhere, every time you will get a new instrument. That is called as the hybrid innovative instruments. So innovative hybrid are structured to serve the variety of a purpose. For example, what are the purpose of hybrid instruments? Simply, hybrids are convertible bearer from bond. Hybrids are a risk management strategy for the commodity. Hybrids are to manage the foreign exchange risk, to mitigate the interest rate risk, also designed to lessen the likelihood of a disagreement between the bondholder and the stockholder. So to minimize the disagreement between, basically. So these are the purpose for which we can say we use the hybrid, innovative hybrids. Okay, now see some questions. So the area for the dividend payment are distributed to the preference share, oftenly known as, when the term area means the dividend is accumulated, that is called as the cumulative preference share. The preference share are a hybrid financial product, that product with the element of, so preference share are hybrid. So when we talk about the hybrid, is the mixture of a debenture and the equity. Okay, so correct option will be C, 2C. Preference share will have two basic characteristics of the debenture and the equity. See, a convertible bond with a par value of 500 is being sold for 520. What is the conversion price if the conversion ratio is 20? So see, here we are having the simple basic formula. Conversion ratio is nothing but the face value upon the conversion price. If they are asking us the what is the conversion price, so conversion price will be face value upon conversion ratio. What is the face value? Face value they have given is what? See, par value is 500 and so selling value, face value will be 500 here. Par value means face value, and the rate is 20. So 500 upon 20 will be 25. Okay, so it will be option C. When a share market price is 30, a warrant contains the right to purchase one share of a common stock and exercisable at 20 per common share. What is the warrant's theoretical value? See, to find the warrant's theoretical value, it is very easy. Market price minus exercisable price. Okay, what is market price? 30 minus exercisable price is 20. Okay, so correct option will be 10. Okay, so B option is your correct option. Now see, a warrant is relatively dash option to buy dash at a predetermined exercise price over the specified long period. So what is warrant? Warrant is what? See, warrant is a long-term option to buy at equity share at to buy the equity. Okay, warrants allow, warrant means simply the coupon. You can buy the equity or shares, that is equity shares, at a after long time, for longer duration, means say after 5 years. Okay, so correct option here will be the D, long term. For it is a long term option to buy the equity. Okay, so friends, you can subscribe us on the YouTube, download the application from the Play Store and join our Telegram channel. Thank you friends.